As you may remember from our previous video on SPACs, these blank check companies have been all the rage over the past year. But SPACs aren't always sunshine and rainbows. Many have seen their share price decline significantly after the merger. So are individual and retail investors just being left as the bag holders? A recent article from the Wall Street Journal seems to suggest that that was the case with some SPAC deals. Insiders have made millions in profits, while individual investors take losses as the company they merge with underperforms. So the example they mentioned in the article was Multiplan, which was a pretty big merger. But since then, their share price really hasn't performed very well. Yet the promoters and sponsors are still set to make millions from it. So the reason that the promoters and sponsors stand to make a fortune even if a stock underperforms post-merger is because SPACs offer shares at huge discounts early on to get investors on board. That means that even if the value of the shares decline post-merger, those same investors are going to make a fortune. Although it must be said the decline in the Multiplan share price was also helped by another fund, Muddy Waters Capital, which publicly announced that the company was overvalued and that they'd chosen to take a short position against it. But in any case, can you start to see where there could be potential problems with this type of model? As Muddy Waters said, it's so asinine that you can get this sort of payday for doing something so value destructive. So since shares in many other SPACs have also underperformed or even declined after the merger, it's unlikely that this is just one isolated event. And this brings us on to what could perhaps be one of the biggest risks for individual investors who do choose to invest in SPACs. If those in charge are set to make money either way, then what's to stop them merging with low quality companies? Because if they don't merge, then the promoters and the sponsors have to give back the money they raised in the IPO, and they will have lost any money that they fronted to cover the startup costs. So that seems like a pretty big incentive to merge. It doesn't sound quite right. So how much would you trust those in charge to put the interests of their investors over their own payday if there's going to be a cost to them if they don't go ahead and merge? Maybe initially they'll be looking at pleasing both parties, but as time goes on, they may start getting desperate, especially since they typically have this 2-year time limit in the US to find and merge with a company. So with the amount of capital in SPACs now surging over the past year, there may end up being fewer and fewer quality companies to merge with as the competition between SPACs heats up. As with many trends in the financial world, once you start taking a look under the hood, it starts to become clear that it's not a win-win for everyone involved, and someone somewhere down the line is paying the price eventually for everyone else's gain. So is that going to be the case here? Let me know your thoughts on the SPAC craze and what you think. Will it all end in tears? Leave a comment and let me know. And don't forget to hit the thumbs up button to support the channel, and I'll see you in the next one. Take care.